Well, we've officially passed the halfway mark of 2024, and joining me today to discuss the opportunities in equity markets, given a noisy and challenging macroeconomic background, is Fund Manager Shaun le Roux. So Shaun, I think many South African investors breathed a collective sigh of relief after the outcome of the local national elections and the formation of the Government of National Unity. And given that we've had something of a lost decade of equity returns for South African investors, how do you see things playing out from here on?
Sure, Audrey, it's been an interesting few months. You referenced the lost decade. What that means in practice is that South African investors have got used to really low returns from equities over the last decade. In fact, if you look at it in dollar terms, if you invested at MSCI South Africa in June of 2014, your total return 10 years later was zero. And you contrast that with the US market, which rose by more than 3 times over the same period. And one can understand why South Africans are disillusioned with local equities. But as you say, we've had some very interesting political developments over the last few months, and you referenced the Government of National Unity. And why we think this is important is because we think the key contributor to that lost decade was governance and failing governance in key institutions. And what we've had since, and to be fair, this process started before the recent election, we've had very important reform at various institutions and improvement in governance. And the market was not prepared to buy into the effectiveness of that reform because we had this election looming. The election's now behind us. The Government of National Unity is in place. It will have challenges. There will be bumps in the road. But now we've got an environment where some of that reform and improvement in governance can start to have a material effect. And material effect in a very depressed market. The base is very low. Foreigners are very underinvested in South Africa, and locals have their lowest domestic equity weighting of all time. We've had load shedding to contend with. We've had issues at Transnet. We've had high interest rates, high levels of inflation. The backdrop, we believe, is conducive towards investors getting used to better returns from domestic assets, and particularly equities, and returns that maybe look a bit more like the 2004 to 2014 period and less like the last decade.
So turning our attention to global markets, I think while we've seen an amelioration of the local environment, offshore things still remain a little bit troubled and cloudy. And one of the biggest factors that's probably looming in people's minds is the US election, of course. So a question for you is, where are you finding opportunities in global markets at the moment?
Yeah, we've just spoken a bit bullishly about South Africa. If we contrast that with the US, we would have grave concerns. We think the US stock market at an index level is actually particularly vulnerable here. What we observe is rising geopolitical tension. We have significant risk attached to the elections, as you referenced. And alongside that, we have a very, very poor fiscal situation in the US. And if anything, it's in the process of deteriorating. And this is in times when the economy is pumping. The fiscal situation becomes extremely concerning if we go into recessionary conditions. But at the same time, markets, up until recently, have been hitting all-time highs. The stock market in the US is very expensive. Price performance has been dominated by a handful of mega cap growth tech names. And that's what everyone owns. If you look into global portfolios, that's what everyone's invested in. Passive has taken a monster market share within the investment community. Yet, when you contrast that with other markets and other parts of the market, there are significant opportunities in uncrowded geographies or uncrowded sectors. And as you would expect, that's where PSG has been shopping over the last few years. So we've been shopping in the UK. In recent times, we've even been shopping in a place like China. We have identified very good opportunities in the real asset part of the market. So what we believe is, looking forward, you need to be invested in different areas to where the average investor is.
So, Shaun, I think given an environment that's likely to remain volatile and where we are likely to see elevated inflation perhaps staying in play, how do you think about portfolio protection? It seems to be a key thing that investors should be considering. How do you approach it?
Yeah, that's a great question. And remember that I described a macro situation where there are deep concerns. So you really need to be thinking about portfolio protection. The issue is that the average global portfolio in the past has effectively lent into this concept of the 60-40 portfolio to protect them against poor economic outcomes. That means they've typically bought G7 bonds, in particular US bonds, and those bonds have been negatively correlated with equities. So when equities have had a tough time, your bonds have done well, and that's balanced things out nicely for you. The macro situation that we see today, we think that's a very poor way of protecting your portfolio. We think it's highly likely that in this environment, bonds and equities are going to be positively correlated. In other words, when equities go down, bonds can go down at the same time, and that's because of the fiscal situation that I spoke about. And we think you need to be reaching into alternatives to protect your portfolio against the inevitable bumps in the road. In our multi-asset funds, we have derivative protection. So we have bought hedges against tail risk in equity markets for the reasons that I spoke to, our concerns around where markets generally are. But we've also looked to alternate ways to protect the portfolio. And in particular, we really like the case for real assets here. We remind investors that there have been periods in the past when real assets have fulfilled a very important role. And I specifically reference the 1930s or the 1970s into the early 80s, or even in the early 2000s, where real assets in the form of property, but in particular in the form of commodities, have not only done well, but they've done well when financial assets are doing poorly. And we see a very tough environment coming for financial assets. And we think real assets have a very important role in the portfolio, both in terms of their ability to generate returns, but also to be negatively correlated with parts of the equity market. And we will specifically reference something like gold. We think this is the time for gold. We contrast the outlook for gold with the US dollar. Our clients have healthy gold exposure, and they'd be cautious of the US dollar at this point of the cycle.
So PSG Asset Management runs a globally integrated investment process. And when you look at the stage that we find ourselves on, how do you weigh the attractiveness of various opportunities right now?
Yeah, it's a challenge. What we're doing is we're looking for the best ideas for our clients wherever they are. And as you suggest, we do have this globally integrated process. So we are able to contrast ideas in different geographies. We also want to diversify. We don't want all of our eggs in one basket. We'd be cautious on the US at the moment, and I spoke to why. And in fact, our clients have got almost no exposure in US stocks. And if we do own US stocks, they're typically businesses like Anheuser-Busch that have got operations in other jurisdictions. But at the same time, what we're wanting to do is we're wanting to grab the best opportunities. Now, I've referenced South Africa and the specific opportunity set here, which we think is as good as we've seen in many years. And consequently, we've been using opportunity to bring dollars back to rands. That commenced, you'll remember in May of 2023, in other words, last year, we had the Lady R incident. The rand was very weak. South African assets sold off aggressively. We would have started to buy some of those very depressed assets, and we would have continued to add going into the election of this year and all the uncertainty around that. So when opportunities arose, we've grabbed those opportunities, but at the same time, we diversified, and our clients are invested in ideas that are uncrowded and look a bit different to most portfolios. So we've been prepared to be a little bit differentiated, But most importantly, we're very excited about those opportunities. When we look 3 to 5 years out, we think now is the time where clients can actually start thinking about getting decent returns from where our portfolios are positioned.
Shaun, thank you so much. Equities are such an important driver of growth, long-term growth in client portfolios. It's great to hear there are many opportunities still on the table.
Thank you, Audrey.